Welcome to the deep dive. Today we are focusing on a truly high-stakes battle over wealth taxation. It's a fight that has just exploded in California, and really it's already sent these seismic waves across the entire financial and political landscape.
It really has. We're looking at a whole stack of sources here. Legal filings, deep economic analysis, and even, the real-time social media reactions from some of the world's most powerful people.
And what's fascinating is that these sources, they don't treat this as just some local policy squabble. It's framed as this symbolic, almost fundamental conflict over fairness, economic mobility, and maybe the very foundation of the modern social contract.
That's absolutely right. And our mission today is, well, it's complex. We need to go way beyond the headlines. First, we have to understand the precise mechanics of this proposed tax, Initiative 25-00224A1.
The nuts and bolts.
Exactly. Then we have to analyze the immediate and, frankly, severe consequences that are already underway. And I mean consequences like massive, measurable capital flight, all before the tax has even been approved.
Which is just incredible.
It is. And finally, we'll connect these local events in California to the broader, decades-long national and, global debates around taxing extreme wealth. We're going to explore the deep structural flaws that critics are pointing to, but also the powerful progressive arguments for fairness that are motivating the whole thing. And most critically, we'll spend a lot of time looking at the proposed alternative models that might actually work, given the long, difficult history of these taxes worldwide.
So the core material really centers on this proposed 2026 Billionaire Tax Act in California, but we're going to use it as a launching pad, constantly comparing it to these serious federal proposals from key lawmakers like Senators Warren, Wyden, and Sanders.
Right.
We've got specific numbers, high-profile names, and a genuine live view of this collision between political power and radical new tax policy. If you, our listener, want to understand how the battle for wealth equity is being fought, and maybe more importantly, how it's being won or lost on the policy design front right now, this is essential.
And the urgency here really cannot be overstated. The sources make it crystal clear. California is standing at a critical crossroads, testing the absolute limits of state authority in a highly mobile, globalized economy.
Yeah.
Whether this initiative becomes a model for other states or whether it just goes down as a costly cautionary tale, it is going to shape tax policy discussions for decades to come, far, far beyond the halls of Sacramento.
Okay, let's unpack this starting right at the very beginning, the trigger event. The sources all point to this key document that's driving the entire furious discussion, which is the initiative filed in late 2025. And it's from the Service Employees International Union, specifically the SEIU United Healthcare Workers West. So my first question is, why did a healthcare union spearhead a billionaire tax? That seems like an odd fit on the surface.
That's a crucial entry point. And the motivation wasn't just, purely ideological, though of course ideology plays a role. It was fiscal urgency. The measure, officially titled the 2026 Billionaire Tax Act, Initiative 25-00224A1, was filed in October 2025. And it's important to remember this is a ballot initiative. That means it bypasses the state legislature entirely and goes directly to the voters. The union saw this as the only viable mechanism to address a crisis they saw coming down the pike.
A crisis? What crisis are we talking about here?
The sources detail a massive projected fiscal shortfall, especially in state-funded healthcare. You have to look at the political context. The GOP-controlled Congress, post-2024, passed something called the One Big Beautiful Bill Act, or OBBA, in July 2025.
Right, the OBBA.
And among other things, the OBBA made a lot of the 2017 TCJA tax cuts permanent, which favored corporations and high earners.
Yeah.
But crucially for California, it included significant, sweeping cuts to federal funding for state-level social programs.
Including Medicaid.
Including Medicaid, or Medicrucal as it's known in California. The state was suddenly facing a projected $30 billion annual budget shortfall in healthcare alone.
$30 billion, wow.
A huge number. So the SEIU framed this billionaire tax as a direct emergency response. It's about safeguarding healthcare coverage, protecting provider payments, essentially using a wealth tax to backfill what they saw as federal abandonment.
So it's a policy rooted in what they see as existential necessity, not just, a policy preference. And the target is, it's incredibly narrow.
Extremely specific. The measure targets roughly 200 individuals and certain applicable trusts in California whose net worth exceeds $1 billion. I mean, statistically, that is less than 0.0005% of the state's population.
A tiny fraction.
And the concentration of wealth is just startling. As of October 2025, The combined wealth of these 200 individuals was estimated at a staggering $2.19 trillion. That's the entire tax base that the state is attempting to leverage.
Okay, now for the actual tax structure, because this is where it gets, I think, the most legally contentious, it's a one-time 5% excise tax. But wait, they're calling it an excise tax on the activity of sustaining excessive wealth. Isn't that just semantics? How does that actually hold up in court compared to a direct property tax?
You've hit the nail on the head. That is the absolute core of the legal strategy, and it's a very precise legal maneuver. If they had called it a direct property tax on intangible assets, it would immediately run into severe constitutional limits in California.
Like the state cap on property taxes.
Exactly. Specifically, the lifted 0.4% cap on intangible property taxes and just general state constitutional prohibitions against unapportioned direct taxes. So, by framing it as a non-ad valorem excise tax on the activity of excessive accumulation, they're trying to tax the state of being wealthy, not the value of the asset itself.
So they're trying to tax the choice to remain a resident in California while being ultra-wealthy.
Precisely. They are attempting to define a whole new taxable event, the maintenance of that status, which they hope the courts will recognize as an excise tax. It's similar to how we tax the sale of gasoline or cigarettes.
Right.
This distinction is critical because excise taxes generally don't require the same strict valuation methodologies or constitutional proportionality that property taxes do. It is aggressive, it's unprecedented, and it immediately invited a massive legal challenge, which we'll definitely get into.
And how is that 5% applied? Is it just a single paralyzing hit?
No, they recognize that would be impossible. A 5% seizure of, say, $10 billion in paper wealth would be catastrophic and impossible to pay immediately. So they built in some compromises.
Okay.
First, there's a phase-in mechanism. The rate increases incrementally from 0% at exactly $1 billion, and it ramps up to the full 5% rate only at $1.1 billion or more. This is designed to soften that threshold shock.
Right, to avoid a cliff edge.
Exactly. And second, the total tax liability is payable over 5 years. It's in 1% annual installments starting in 2027. They even include a minor deferral charge. It's about 7.5% annual interest on those deferred amounts to compensate the state for not getting all the funds up front.
Let's get granular on the scope. Who exactly pays this and what is counted as their wealth? Because this is where the whole controversy over mobility and jurisdiction really kicks off.
Right, so the tax applies to California residents, part-year residents, and applicable trusts. Married couples are treated as a single taxpayer based on their combined net worth. And crucially, the calculation is based on the total fair market value of all worldwide assets minus any debts or liabilities.
Worldwide assets. So that's an attempt to capture wealth that's, hidden in complex global structures.
It is. They're trying to pierce that veil.
So what's included in this worldwide net worth? We know billionaires don't keep their money under a mattress.
No, it's all structured. The bulk of it, and the sources estimate approximately 72% of that targeted $2.19 trillion base, is in publicly traded stocks. And those are valued relatively easily using SEC records and daily market prices.
That's the easy part.
That's the easy part. But the scope is immense, designed to pierce all the standard avoidance structures. Inclusions cover private businesses, intellectual property, art, business-owned real estate, and all offshore assets.
Okay, but how exactly do they value those complex private businesses? That's not a daily stock price.
And this is where the administration gets to be a complete nightmare. The sources detail the methods. For private businesses, the state requires valuation via these complex formulas. Things like book value plus a multiple specifically, 7.5 times the average annual book profits.
That sounds contentious.
It's incredibly contentious. Or they use transaction-based methods if the company has recently raised capital. This is not a system the Franchise Tax Board, the FTB, is set up to enforce reliably.
Yeah.
It immediately invites valuation disputes, where every single asset over a certain size becomes a potential piece of litigation.
They also built in some exclusions, I assume, to avoid conflicts with existing state tax law and to avoid taxing things they can't legally touch.
Precisely. They were very careful here. They explicitly excluded directly held real property, specifically to avoid conflicts with Proposition 13, which of course limits property tax increases in California.
Right, the third rail of California politics.
You can't touch it. They also excluded tangible personal property that's kept outside California for 270 or more days in 2026, qualified pensions and retirement accounts, and up to $5 million in miscellaneous personal assets, like jewelry or cars.
Pragmatic moves.
Very pragmatic. They're trying to defang some of the political opposition, by avoiding taxes on primary homes or retirement savings.
And what about the avoidance tactics that the wealthy are so famous for? The shell companies, the trusts. How did the SEO try to counter that?
Well, they attempted to pierce those common avoidance structures. The sources explain that indirect ownership via trusts or shell entities is explicitly ignored, meaning they look through the structure to find the beneficial owner. They mandated the reporting of offshore assets and included credits for similar taxes paid elsewhere to prevent double taxation. And, maybe most importantly, the Franchise Tax Board is authorized to make ex post adjustments upon an asset sale.
What does that mean in practice?
It means if a billionaire reports an illiquid asset value of, say, $500 million, and then sells it 6 months later for $1 billion, the FTB can go back and reevaluate the original tax liability. It makes aggressive undervaluation very, very risky.
Let's circle back to the revenue. $100 billion over 5 years is an astronomical amount of money for a state initiative. How did they arrive at that figure, and where is that money contractually obligated to go?
The projected revenue aims to generate that $100 billion over 5 years. The calculation was based on the $2.19 trillion tax base, applying the 5% rate, and then they adjusted it downwards by a pretty cautious 10% to account for anticipated avoidance and evasion.
So they baked in the assumption that some people would try to dodge it.
They did. It's a recognition that some wealth would inevitably move or be hidden. But the destination of the money is absolutely key to the political argument.
It's constitutionally protected, right? It can't just be thrown into the general fund.
Absolutely. The funds are earmarked for constitutional accounts outside the general fund, ensuring they can't be easily diverted by politicians. 90% is allocated to health care, directly offsetting those feared federal cuts to Medicaid, stabilizing premiums, and protecting jobs.
So it directly addresses that $30 billion shortfall.
It's the existential purpose of the whole thing. The remaining 10% goes to K-14 education and food assistance programs. It is designed, both politically and fiscally, as a dedicated emergency measure funding immediate, highly visible social needs. And that framing is essential when we start discussing the due process arguments later on.
Okay, this is where the policy just collides violently with economic and legal reality. The minute this initiative was filed, it triggered a fierce, immediate backlash. And it seems to center on this one toxic combination: the tax being retroactive and it being applied in a mobile economy.
That combination, retroactivity and mobility, is the explosive core of the opposition. It's absolutely right. Let's focus on the timing. The liability for the tax attaches based on your residency as of January 1st, 2026.
Okay, January 1st.
But the voters won't approve or reject the tax until the election in November 2026, and the official valuation date doesn't even occur until the end of December 2026. So this creates this 10-month gap where a tax liability is accruing based on a law that may or may not ever exist.
That is fundamentally retroactive. The critics are calling this a severe violation of constitutional due process. Can you elaborate on that specific legal vulnerability?
The vulnerability is massive, and it was entirely predictable. The 5th and 14th Amendments guarantee due process, which means the government can't just arbitrarily deprive citizens of property. Taxpayers generally have a right to rely on existing tax laws when they're making economic decisions.
Right. You need predictability.
You need predictability. Critics argue that requiring someone to pay a 5% tax on wealth they accumulated over decades based on their residency status 11 months before the law is even passed is completely arbitrary and, in their words, confiscatory.
So what's the legal standard that courts use when they're looking at retroactive taxes? They're not always illegal, are they?
No, not always. Courts usually apply what's called a rational legislative purpose test. Retroactive taxes are upheld, but only if they serve a clear, rational, and limited purpose. For instance, closing a loophole that was just discovered, or correcting a clear error. And usually it only covers a very short previous period.
But this isn't a small correction.
Not at all. And crucially, courts are highly suspicious of taxes that constitute a wholly new tax being applied retroactively. Since the 2026 Billionaire Tax Act is framed as an entirely new excise tax, not just a tweak to a pre-existing income tax rate, it faces very severe judicial skepticism.
So even if the state argues the purpose is rational funding a healthcare crisis, the court might still strike it down because the tax itself is so unprecedented.
Exactly. The predicted outcome, according to the legal analysis we reviewed, is just years of protracted litigation. The absolute best-case scenario for this state is that the court reforms the effective date, pushing the liability back to January 1st, 2027, or maybe the date the law was passed.
And what does reforming the date due to that $100 billion goal.
It fatally undermines it.
Yeah.
That $100 billion is calculated on the assumption that the liability locks in the minute 2026 begins, right? It captures the wealth of everyone resident then, regardless of whether they leave later in the year.
So it's a trap.
It's meant to be. If the date shifts to 2027, the initial year of $20 billion in revenue just vanishes. And critically, it gives every single one of those 200 billionaires a clear 12-month window to establish non-residency somewhere else before the tax ever takes effect.
The opposition isn't just abstract legal theory, though. We're seeing powerful, immediate, and very high-profile opposition from the financial sector.
Absolutely. The hedge fund billionaire Bill Ackman, he called the proposal catastrophic. He warned that it jeopardizes the rule of law because it eliminates that legal predictability we talked about. He even likened it to an expropriation of private property.
Wow.
But the deepest resistance by far comes from Silicon Valley, which is the engine of California's entire economy.
And the threat is not just talk, it's quantifiable capital flight. This is maybe the most shocking detail in all the sources.
It is the moment where theory just crashes into reality. According to the venture capitalist Chamath Palihapitiya, who's been tracking these moves as of January 2026, the collective wealth that has already left California or is in the process of ensuring non-residency status for 2026 is now in excess of $700 billion.
Wait. Let's pause on that number, 700 million.
At least. He suggests the true figure might be up to $1 trillion.
$1 trillion. If the original tax base was around $2 trillion, that's a 35% to 50% reduction in the targeted wealth base before the tax is even passed. How can the state possibly recover its $100 billion goal with a tax base that small?
It can't. Not without dramatically increasing the rate, which would only accelerate the flight. This is the core tragedy of a state-level wealth tax in a highly mobile economy. It highlights the vulnerability. You're imposing a tax on a global asset class with only local authority.
And the capital just moves.
The capital just plays whack-a-mole. It moves to jurisdictions with better tax environments: Texas, Florida, Nevada. The sources provide specifics. Reports indicate that Peter Thiel and Larry Page are accelerating plans to sever ties by the end of 2025, specifically to avoid that January 1st, 2026 residency lock-in.
And their cost avoidance is massive, I take it.
Oh, it's huge. If they successfully sever ties by the end of 2025, they avoid a liability that could cost them over $1.3 billion each. But the greater cost to California isn't that single excise tax. It's the loss of the future, massive stream of state income tax, capital gains tax, and all the broader economic activity generated by their presence.
Right, their foundations, their businesses.
All of it. As the prominent venture capitalist Vinod Khosla warned, the state would net off much worse due to the overall economic shrinkage.
This sounds like such a severe self-inflicted wound that even the state's most powerful Democrat, Governor Gavin Newsom, has publicly opposed it.
He has, and his opposition is a recognition of this economic reality. Governor Newsom has pledged to fight the initiative. He stated unequivocally that California risks becoming a cautionary tale if it tries to tax extreme wealth unilaterally.
Yeah.
The fear is that the state is undermining the very innovation economy that sustains its entire budget. The San Jose Mayor Matt Mahan echoed this, calling the measure ill-conceived because it targets the risk takers and job creators at the heart of the state's economic strength.
Let's talk about the political rhetoric of the opposition, specifically this Trojan horse argument. This frames the tax not just as bad policy, but as some insidious threat to privacy and future liberty.
That narrative is extremely powerful in Silicon Valley. David Sachs called the initiative an asset seizure and a Trojan horse. The argument is basically twofold. First, enforcing a wealth tax requires deep, unprecedented state surveillance of every private asset you hold: your art, your IP, your foreign bank accounts.
And second is the slippery slope.
That's the one. The argument is that the $1 billion threshold, once it's breached and normalized, can easily become $10 million or $50 million tomorrow. Sachs and others, they fear this sets a precedent for total fiscal intervention, where rates and exemptions are just hollowed out over time due to political pressure.
So the income tax analogy started narrowly, then became universal.
Exactly. They fear the wealth tax will follow the exact same path, eroding private property rights for everyone, not just billionaires.
Okay. Beyond the politics and the mobility, let's pivot back to the technical issues that make this plan, well, a bad design policy. The economic distortions inherent in taxing illiquid assets.
This is the valuation nightmare we touched on earlier, and it is the single biggest policy flaw. The challenge lies in calculating net worth for illiquid assets: private equity, startup shares, intellectual property, art. These assets don't generate cash flow until they're sold, but the tax is due annually in installments.
And that forces sales.
It forces sales. Wharton economists note that this situation forces startup founders to liquidate personal assets, sell stakes prematurely, or borrow heavily just to cover taxes on unrealized gains. This fundamentally shifts the calculus of risk-taking. It punishes entrepreneurs for holding on to and building long-term businesses.
And we have that chilling concrete example of this provided by Palmer Luckey. Can you detail that extreme scenario for an illiquid founder?
Lucky's example perfectly illustrates the potential for personal and administrative disaster. So imagine a founder CEO of a private company worth $1 billion. Because they took venture capital or have complex equity structures, they may only personally own 3% of the company, valued at, say, $30 million.
Sorry, $30 million.
But the initiative's rules mandate that their total net worth is calculated based on the fair market value of the company itself, especially if they maintain 100% of the voting power. In this theoretical but very realistic case, the founder could be hit with a $50 million tax bill on a functional net worth of only $30 million.
Wait, so they owe $50 million, but their liquid wealth is only $30 million? How is that even possible? And how do they pay it?
It's possible because the valuation rules focus on the total theoretical worth tied up in the asset, not the liquid cash flow or the actual economic benefit the founder can extract immediately. The tax applies to that total fair market value. The founder would be forced to borrow or potentially face personal bankruptcy, even with the 5-year deferral plan.
Because they're being taxed on a value they can't access.
Exactly, a value they can't access without destroying the company's structure or selling their controlling stake prematurely. It creates an intense, possibly fatal tax burden on the very structure of ownership. Even with deferrals, that constant looming annual 1% installment puts immense financial strain on illiquid founders.
And finally, there's the apportionment challenge for people who are, trying to be part-year residents or claiming they're no longer in California.
Yes, for full-year residents, it's 5% on their entire worldwide wealth. Simple. But for partial residents, the state anticipated disputes over how much of their wealth was truly accumulated in California.
So they created a floor.
They created a floor. The alternative apportionment method they adopted sets a minimum apportionment of 25% of the total tax liability, regardless of how much time the individuals spend in the state, unless a court intervenes. This 25% floor is designed to prevent wealthy part-year residents from claiming negligible state ties, but it's just another major legal vulnerability, inviting complex legal disputes over jurisdictional reach. The entire structure is not just aggressive, it is riddled with legal and technical pitfalls.
California's deeply flawed attempt brings us perfectly to the national stage then, because the same underlying problem, runaway inequality, low effective tax rates for billionaires, it exists everywhere. And progressive Democrats have introduced proposals that are, I think, trying to solve the mobility and valuation problems that are crippling this California initiative.
They are. But the political context nationally is deeply challenging for these proposals. Given the recent passage of the OBBA and the political makeup of Congress, are these federal wealth taxes anything more than symbolic legislation at this point?
That's a great question. They are very unlikely to pass the Republican-controlled Congress post-2024. As we mentioned, the OBBA not only cut social spending, it permanently extended many favorable TCJA benefits and raised the estate tax exemption to a generous $15 million, inflation-adjusted, starting in 2026.
So the political trajectory is currently moving away from taxing wealth.
It is. However, these proposals are intellectually crucial because they are the blueprints for the progressive movement. They frame the core policy debate on how to tax unrealized gains effectively.
And unlike California, which has its own state-level constitutional restraints, federal proposals have to deal with the monumental hurdle of the 16th Amendment.
This is maybe the most significant structural challenge nationally. The 16th Amendment allows the federal government to tax income from whatever source without apportionment among the states. But traditionally, the Supreme Court has deemed direct taxes on property, like a wealth tax, unconstitutional unless they were apportioned across the states based on population.
A standard that's just impossible to meet for individual wealth.
Impossible. So the 16th Amendment gave Congress the power to tax income, but it didn't explicitly grant the power to tax wealth, which is property.
Precisely. That historic distinction is the key legal battlefield. So proponents of federal wealth taxes, they have to strategically reframe the growth of wealth as income. They argue that an increase in net worth, an unrealized gain, is functionally income, and therefore taxable under the 16th Amendment.
And that legal strategy is why so many of these proposals focus on mark-to-market accounting.
Exactly. They're trying to redefine income.
But despite the political and constitutional roadblocks, there's still enormous public momentum behind the idea.
Absolutely. Polls consistently indicate broad public support, something like 70% favoring higher taxes on billionaires. This widespread appetite for fiscal reform is what keeps these proposals alive. Even if they aren't passing Congress today, they represent a significant segment of public will.
Okay, let's dive deep into the four primary federal models that are circulating. They all seem to be attempts to solve the illiquidity and valuation problems that have surfaced in the California disaster. Let's start with Senator Ron Wyden's approach, which is very distinct.
Right. So Senator Ron Wyden's Billionaire Tax Act is not a wealth tax in the traditional sense. It's a tax on income. It proposes mark-to-market annual taxation on unrealized gains for liquid assets, primarily publicly traded stocks and easily valued securities.
So if I buy $100 million in Tesla stock and it appreciates to $110 million by the end of the year, I pay tax on that $10 million gain even though I haven't sold it.
That is the core mechanism. It directly addresses the constitutional hurdle by arguing that appreciation is income. It targets individuals with over $1 billion in assets or are $100 million in income for 3 consecutive years. And importantly, Wyden's plan is pragmatic about the valuation problem. Illiquid assets, like private companies and real estate, are deferred until sale.
So that avoids the Palmer-Luckey nightmare scenario.
It significantly reduces it. But you still have the question, if you tax the unrealized gain, where does the founder find the cash if they can't sell their controlling shares? It still seems to create a liquidity problem, just a smaller one.
Right.
And that's why Wyden's proposal includes an option for taxpayers to pay the tax over 5 or 10 years with interest. For highly liquid assets, public stocks, the tax is on the appreciation. If you have $10 billion in Amazon stock, you can sell a fraction of 1% to cover the liability. The deferral and installment structure is designed to handle that residual liquidity pressure. But the ultimate goal, and what makes this plan so strategically important, is closing the buy, borrow, die loophole.
Okay, explain that loophole fully because it's absolutely central to this entire debate.
The buy, borrow, die loophole is how the ultra-wealthy, who derive minimal salaries, fund their entire lifestyle while legally avoiding income tax. First, they buy appreciating assets, like stocks. Then, they borrow cash against those highly appreciated assets using securities-backed loans, which are not taxable events.
So they get cash without selling.
Cash without selling, so they never incur a capital gains tax. And finally, when they die, the asset receives a stepped-up basis to the current market value. This means the entire lifetime of unrealized gains is passed completely tax-free to their heirs. Wyden's mark-to-market plan aims to tax that appreciation annually, making the entire strategy unviable.
And the revenue potential is huge.
Hundreds of billions over a decade just from closing that one loophole.
Okay, next, let's look at the most recognized proposal, the Warren Plan, which is a more traditional wealth tax.
Right. Senator Elizabeth Warren's Ultra-Millionaire Tax Act is an annual tax on net worth. It's similar in concept to the European models we'll discuss, but with more moderate rates. It targets roughly 75,000 households with a net worth starting at $50 million.
So that $50 million threshold is much broader than California's focus on just 200 billionaires.
Yes. It aims for a deeper pool of ultra-high net worth individuals, not just the hyper-elite. The structure is a 2% annual tax on net worth between $50 million and $1 billion, plus a 1% surtax above $1 billion, escalating the rate for the very richest.
And it has some serious anti-evasion rules built in.
Very serious. Warren's plan is notable for its aggressive revenue target and its built-in anti-evasion rules. She includes crucial provisions specifically targeting sophisticated tax avoidance mechanisms like complex trusts and offshore holdings, which are estimated to cost the government $5 to $7 billion annually in lost revenue.
And the revenue estimate.
Warren estimates this model could raise a staggering $3.75 trillion over 10 years, making it the most ambitious federal revenue generator proposed.
The third model, the Robin Hood Act, seems laser-focused on just one part of that buy, borrow, die strategy.
It is. The Robin Hood Act, championed by Representative Dan Goldman, is a highly surgical excise tax approach. It imposes a 20% excise tax, specifically on new loans or lines of credit that are backed by appreciated assets.
So it doesn't tax the wealth or the appreciation, it taxes the act of consuming the wealth through borrowing.
Exactly. Goldman sees this as correcting a fundamental flaw in the tax code that allows the rich to access billions tax-free. By taxing the loan, you are taxing the economic benefit derived from the wealth, even if the underlying asset is never sold.
And the numbers on that.
It targets an estimated $138 billion in securities-backed loans held by high-net-worth individuals, projecting $276 billion over 10 years. It's a clean, hard-to-dodge mechanism because the loan itself is a concrete, observable transaction.
And finally, Senator Bernie Sanders, whose proposals tend to be the most ambitious in terms of rates and scope.
Senator Sanders has historically proposed an escalating annual tax with very high top rates. It starts at 1% on net worth above $32 million, but then it rises steeply, all the way up to 8% on net worth above $10 billion.
Wow, 8%.
A huge rate. And while earlier estimates suggested up to $4.35 trillion over 10 years, more conservative models place the revenue potential closer to $2.8 trillion. Sanders frames these taxes as necessary funding for expansive social programs like Medicare for All, and he has explicitly supported the California Billionaire Tax as a model to emulate nationally.
So if we look across all four of these proposals, what is the single most important lesson they seem to have learned from the global failures and California's immediate catastrophe?
I think they've learned that you have to find a way to tax the economic flow or the benefit derived from wealth, not just the static, hard-to-value, and easy-to-move stock of wealth. The Wider and Goldman focus on mark-to-market and loan excise taxes is a direct policy evolution away from the pure net worth tax, precisely because they're structurally designed to address buy, borrow, die, and the constitutional definition of income.
And we have to remember the moral case underpinning all of this. What's the data that proponents like Nobel laureates Paul Krugman and Joseph Stiglitz rely on to justify these aggressive measures?
They rely on the sheer undeniable data showing wealth concentration and low effective tax rates. They highlight that the top 0.1% of the population controls roughly 20% of all U.S. wealth.
20%.
And the growth disparity is maybe the most damning statistic. Billionaire wealth has grown at an astonishing 7.5% annually since 1982 compounded versus only 1.5% for average incomes.
So the gap is just widening exponentially.
Exponentially. And despite this phenomenal compounding of wealth, the effective tax rate for many billionaires often hovers below 1.5%. So for proponents, a wealth tax, especially a moderate one at 1.2%, is a necessary progressive tool to promote equity and help offset the projected $1 to $2 trillion in deficits caused by tax cuts that overwhelmingly favored the top 1%. They see it as fundamentally restoring a fair tax system.
Right. So the U.S. is really late to this game. Before California's attempt, wealth taxes were already experiencing a political revival globally, driven by the same rising inequality data. But the history of these taxes is, well, it's arguably dominated by abandonment and failure. If California wants to succeed, they have to look at this global laboratory.
They absolutely must, because the global experience teaches a very harsh, consistent lesson in policy design versus political ambition. Comprehensive net wealth taxes were widespread across post-war Europe. They were seen as a tool for rebuilding social contracts. Yet they've been largely repealed across most advanced economies.
And not because of a political shift to the right, you're saying?
Not primarily. It's because they simply didn't work effectively.
So which major countries threw in the towel, and what were the consistent shared reasons for failure?
The list is long. Countries that repealed broad, recurring net wealth taxes include major economies like Austria, Denmark, Finland, Germany, Iceland, Luxembourg, the Netherlands, and Sweden. The reasons were remarkably consistent across the entire continent, almost like a cautionary checklist for California.
Okay, lay out that checklist for us. What were the predictable flaws?
First and foremost, valuation disputes and administrative complexity. The state tax authorities simply could not reliably assess the value of private businesses and illiquid assets every single year without massive litigation and bureaucratic cost.
The same problem California is facing.
The exact same problem. Second, significant capital flight. Wealth, being highly mobile, fled to non-wealth tax jurisdictions, shrinking the tax base. And third, modest revenue yields. Despite all the political fanfare, the tax is typically raised only between 0.2% and 1.2% of GDP.
So the administrative burden and political costs just weren't worth the fiscal reward?
Not at all. That summary I saw in the sources, calling them heavy machinery for light excavation, is perfect.
Yeah, that really captures it.
It does. They were politically powerful symbols, but fiscally underwhelming. They behaved less like a robust revenue stream and more like porous dams. They held some water, but most of the capital flow managed to escape.
So if most advanced economies abandon them, who still taxes net wealth, and how have those few survivors managed to navigate the mobility problem?
Only a handful of OECD countries maintain broad, recurring net wealth taxes today. Norway, Spain, Switzerland, and Colombia. And their survival relies entirely on specific structural nuances that mitigate that float risk.
Let's start with Switzerland. How does its system work differently?
Switzerland's system is highly decentralized. It relies on cantonal authority. The rates are extremely low, typically below 1%, but the coverage is very broad. Because the rate is so low, and because the tax is applied locally across all 26 cantons, the incentive for a Swiss resident to move their wealth is greatly reduced.
It's the difference between a pinprick and a hemorrhage.
That's a great way to put it. And then you have Norway, which is often cited as a cautionary tale itself regarding taxing unrealized gains. Norway is complex. It combines national and municipal layers and applies the tax at surprisingly low thresholds compared to the U.S. proposals. But they ran into severe problems taxing unrealized gains on small and medium-sized enterprise owners. This forced founders to sell stakes in their growing businesses prematurely just to pay the tax.
Which led to entrepreneurial flight.
It did. High-profile flight to countries like Italy. And this specific problem is a direct echo of what Palmer Luckey warned about in California, demonstrating the difficulty of imposing an annual tax on illiquid assets, even with seemingly moderate rates.
And Spain's system sounds like it was a policy designed to fail because of internal political fragmentation.
Spain's situation is fascinating because it illustrates the dangers of internal tax competition. The tax is fragmented by region, and regions like Madrid offer near-total exemptions. This created a massive internal race to the bottom, where wealthy citizens simply moved their residency a few hundred miles to avoid the tax.
So the central government had to step in.
They did. The federal government was so alarmed by the low revenue that they had to introduce a national solidarity tax in 2022 to counter the regional exemptions. It's essentially a domestic version of the global coordination problem.
So the global consensus seems to be that if you can't abandon the idea entirely, you move to narrow asset-specific substitutes. What are those?
That's the primary trend in Europe. France, for instance, abandoned its broader wealth tax and now only taxes high-value real estate. Belgium taxes large securities accounts. Italy focuses on foreign-held assets. And the most elegant solution might be the Netherlands, which taxes imputed returns on wealth rather than wealth itself.
So they assume your wealth will generate a certain return, and they tax that theoretical income stream.
Exactly. It bypasses the annual valuation of the stock of assets entirely. It moves the policy firmly back toward taxing flows rather than stock.
This global history brings us back to California's structural anomaly. Almost all historical wealth taxes were annual and recurring. California's 5% levy is framed as one-time. Is there valid historical precedent for a one-time levy on wealth?
There is, but it's limited to moments of profound systemic crisis, and this distinction is crucial for California's legal defense. These one-time levies function as fiscal emergency measures.
Like in Argentina.
Exactly. We saw this with Argentina's 2020 COVID-19 solidarity tax, which imposed a one-time charge on high-net-worth individuals explicitly to fund pandemic relief. Post-war Europe also used significant capital levies after both world wars to pay down war debts and stabilize currencies.
So what's the key distinction? If California is facing a $30 billion healthcare crisis due to federal cuts, isn't that an exceptional circumstance justifying a one-time levy?
Legally and politically, it's a very fine line. The historical levies were successful only when they were framed as exceptional one-off measures responding to acute national security-level emergencies. They were politically accepted because the entire population understood the shared sacrifice.
But California's proposal is different.
It straddles this line dangerously. It is legally a one-time excise tax, but rhetorically, its proponents frame it as a necessary structural correction for decades of inequality and a permanent funding source for ongoing social needs. This blend, a one-time hit carrying structural symbolic weight, increases the political and legal tension.
So the opposition can argue it's not really an emergency response.
That's their argument, that funding ongoing structural deficits via a one-time measure proves it's a poorly disguised, structurally weak, permanent policy goal. The global experience just reinforces the key takeaway for California. Wealth taxes fail because they fight gravity.
The natural tendency of capital to be mobile.
Right. And a state-level attempt like this without national or international coordination is simply trying to apply local authority to an inherently global asset class. It's a battle it's almost guaranteed to lose, evidenced by that $700 billion flight.
We've touched on the illiquidity problem, but let's dive deeper. This is arguably the most complex administrative and economic problem, threatening the very innovation engine California relies on. How big of a technical hurdle is calculating the fair market value for assets that don't trade daily?
It is an administrative nightmare on a scale the Franchise Tax Board has never faced. We are talking about valuing intellectual property, controlling stakes in private equity firms, early-stage startup shares, and highly subjective assets like major art collections. There's just no existing robust mechanism in the tax code for this kind of annual valuation.
And the inclusion of formulas like book value plus 7.5 times the average annual book profits sounds right for litigation.
Absolutely. Those valuation methods are inherently open to subjective interpretation and legal challenge. Every major valuation becomes a guaranteed tax dispute. This invites extensive evasion through creative accounting and intentional undervaluation.
And for a high-growth state like California, it actively stifles risk-taking.
It does, because it creates a clear incentive to minimize the stated value of your company, or to simply move the legal domicile of your IP and private businesses out of state entirely.
Let's use that specific high-profile example involving the founders of Alphabet, Larry Page, and Sergey Brin, to demonstrate the complexity of valuing control versus market value.
This example perfectly illustrates the policy's potential for distortion. Page and Brin each own approximately 3% of Alphabet stock, which is valued at over $120 billion each. However, their shares carry a massive structural advantage, 10 times the voting power of standard stock.
And why does that matter for the wealth tax?
It matters because the tax applies to the total fair market value of their holdings, and the valuation of their total net worth is intrinsically linked to the functional control and voting power they hold over Alphabet. Critics warn that they could be taxed disproportionately because the tax aims at that high theoretical value.
So if they were forced to sell portions of their stock to pay the tax, they would dilute their controlling power.
Exactly, potentially destabilizing one of the world's most valuable companies. This leads us back to the practical payment dilemma, which is acute for founders, even with a 5-year deferral.
Right, the deferral plan offers an installment option, but it doesn't solve the core problem of illiquidity.
Not at all. A founder CEO who owns 100% of a private, growing company worth $1 billion might have a tax bill of $50 million, but zero cash flow. They face 3 bad choices. 1, borrow against the asset. 2, sell estate prematurely. Or 3, face personal bankruptcy.
And forcing those kinds of liquidation events risks disrupting the entire business.
It does. The state is effectively taxing away the incentive to found and scale a multi-billion-dollar company within its borders. Why risk years of hard work and massive personal liability if the reward is a forced asset sale just to pay an excise tax on paper games? The result is not just a shrinking tax base from capital flight, but a long-term chilling effect on the creation of new wealth and new jobs.
Let's move to the psychological and political hurdle that really dominates the opposition narrative. The fear of expansion, the slippery slope.
The precedent argument is politically powerful because it taps into historic anxieties about government overreach. Opponents argue that the $1 billion threshold is merely the opening salvo. Once the mechanism for monitoring and taxing net wealth is established, once the Trojan horse is inside the gate, future ballot measures or legislative changes will inevitably expand the tax to lower thresholds.
And they use the historical trajectory of the federal income tax as their primary analogy.
They do, and the analogy is effective because it's historically accurate. Critics recall that the federal income tax, introduced in 1913, started as a narrow levy targeting only the wealthiest 1% of the population. Over the course of the 20th century, that levy became universal.
So the argument is simple. Today's $1 billion threshold could easily become tomorrow's $10 million.
Turning a targeted billionaire tax into a broad, invasive personal property tax. David Sachs and others warn that this sets a dangerous precedent for surveillance and future fiscal interventions, eroding privacy and property rights as political pressure inevitably dictates that the revenue base must be widened.
Now, a key nuance. Not all criticism of the California plan is coming from the ideological right or from billionaires themselves. Some progressive economists also view this specific proposal as deeply flawed policy.
That's a critical distinction. These economists oppose wealth inequality just as much as the SEIU, but they view this CA proposal as structurally weak and administratively unsound. They argue it's bad policy because it relies on a new, fragile bureaucracy for net worth valuation, and it targets an asset class that is the easiest to dodge.
So their concern is that a high-profile failure in California will actually set back the national goal of wealth equity by years.
Exactly. It'll prove that wealth taxes just don't work.
So if progressive economists acknowledge the goal but reject the mechanism, what tools do they favor instead?
They favor mechanisms that leverage the existing robust tax infrastructure and focus on revenue streams that are harder to dodge and more legally secure. Their preferred alternatives include: first, significantly higher top marginal income tax rates. Second, taxing capital gains as ordinary income, eliminating the preferential treatment. And third, raising corporate taxes. These methods avoid the administrative and legal quicksand of annual net worth valuation.
In summary, then, the debate in California is profound. Supporters frame the tax as an essential, urgent act of equity. Opponents frame it as expropriation and a catastrophic self-inflicted wound.
Right. The policy debate is fundamentally a symbolic reckoning with wealth inequality. But the policy's poor design risks making the symbol more damaging than the revenue is helpful.
Okay, so the consensus emerging from our detailed analysis is that the California initiative, while morally compelling, is structurally fragile and likely doomed due to retroactivity, valuation, and capital flight. So the constructive discussion then shifts to what would actually work. The sources offer 3 blueprints for taxing wealth, effectively moving from the populist urge for extraction to the precision engineering required for durable policy.
This is the crucial section for the learner. We are synthesizing the lessons from European failures, the constitutional constraints in the U.S., and the mobility issues currently underway in California. The core lesson is that successful tax policy must integrate mechanisms to govern capital mobility and focus on measurable flows.
Let's start with the state level, where the constraints are the highest. How can a state like California design a successful wealth-oriented tax without triggering massive capital flight?
The proposed model is a wealth proceeds tax, which fundamentally shifts the focus away from static net worth. The core principle is focusing on realized economic flows, like capital gains, dividends, and interest, rather than taxing illiquid stockpiled net worth. This bypasses the valuation nightmare and greatly reduces administrative cost.
Can you provide a concrete example of this design?
Yes. Analysts suggest a design like a moderate 4% surtax on annual investment proceeds above $1 million. This tax targets genuinely wealthy households that are generating significant taxable flows from their capital every year. It avoids taxing the illiquid founder who is building a private company without cashing out.
And the revenue potential is still significant.
It is. Estimates suggest such a design, being more durable, could raise $45 to $57 billion annually across U.S. states that adopt it.
But doesn't focusing only on realized flows let the buy, borrow, die loophole survive, where the wealthy just borrow against their wealth instead of realizing gains?
It partially preserves that loophole, yes. But the proceeds tax is designed to work in conjunction with state-level mechanisms to address mobility, which is the immediate threat. And that means states must deploy aggressive exit taxes, modeled on federal expatriation rules.
How does the state-level exit tax work, and why does it deter mobility?
The federal government currently imposes an exit tax on Americans who renounce citizenship, taxing all their worldwide assets as if they were sold the day before they left. A state-level exit tax would do something similar. If a high-net-worth resident relocates, say, Peter Thiel leaves California for Florida, California recaptures all of the deferred or unrealized gains accumulated while he was a resident.
So it transforms relocation from an escape mechanism into a simple timing decision.
That's the key. You can move, but you must realize and pay tax on the accrued benefits before you leave. This ensures that wealth created under the state's infrastructure eventually contributes to the tax base.
Moving to the national level, where the U.S. government has far more scale and enforcement power. If the U.S. were to design a workable wealth tax, which key features must it prioritize?
At the federal level, the design must prioritize the strategies we already saw in the Wyden mark-to-market plan. The scale is the advantage. Mobility is less threatening, and enforcement capacity is stronger with the IRS.
So what are the 2 key design features?
First, mark-to-market taxation on publicly traded liquid assets, framing appreciation as income to bypass the 16th Amendment issue. This directly addresses the buy, borrow, die problem. Second, enacting strong anti-abuse rules, and significantly expanding IRS enforcement capacity.
Which is critical.
Critical. The sources emphasize that expanded IRS funding focused specifically on ultra-high net worth audits is key to recovering liabilities currently hidden offshore, estimated at roughly a quarter of tax liabilities for the wealthiest.
And what is the sheer revenue potential if a national tax is designed robustly?
It's transformative. The sources indicate that a moderate 1% tax on net wealth above $50 million could generate nearly $2 trillion over a decade.
But even a robust national tax runs into the fundamental global problem. Wealth is global and national tax authority is local. How do you conquer tax havens, which drain hundreds of billions annually?
This is the inevitable constraint. National reforms cannot fully succeed because wealth is global while tax authority is local. Tax havens drain an estimated $475 billion annually from public coffers worldwide. The only durable, truly effective solution is coordination on a global scale.
Tell us about the coordination proposal championed by the economist Gabriel Zucman.
Zuckman's proposal, put before the G20, is for a global minimum wealth tax of 2% on billionaires. This is a moderate, agreed-upon rate applied internationally, designed to affect roughly 3,000 individuals worldwide. Because it's globally coordinated, billionaires can't just shop around for friendlier jurisdictions. It's estimated to raise a highly significant $200 to $250 billion per year.
But how do you enforce a global tax floor without a global government? What institutional vehicle would make this stick?
The proposal centers on establishing a UN tax convention. And this convention would create three indispensable enforcement tools. First, a mandatory global asset registry that tracks all cross-border holdings. Second, mandatory automatic information exchange between nations. And third, and most critically, penalties for non-cooperative jurisdictions, meaning tax havens.
What kind of penalties are we talking about that would actually make secrecy an economic liability?
We are talking about penalties designed to enforce a floor, similar to how the OECD enforced its global minimum corporate tax. This could involve denying treaty benefits to companies operating in non-compliant havens or applying automatic withholding taxes on capital flows originating from those jurisdictions. The goal is simple: to make tax secrecy so economically costly that the haven jurisdictions are forced to comply. What this detailed analysis really shows you is that wealth taxes fail less because they're illogical and more because they are just poorly designed, especially when capital mobility is ignored. The path forward involves precision engineering, integrating state exit taxes, focusing on proceeds, refining national mark-to-market systems, and achieving true global coordination.
So we've taken a deep dive into the California Billionaire Tax Act, tracing its highly aggressive structure, a one-time 5% excise tax intended to generate $100 billion for urgent healthcare and education funding. We've analyzed the furious, immediate backlash, understanding why figures from Elon Musk to Governor Newsom have opposed it, and we've charted its potential demise in the courts.
Right, due to that toxic combination of retroactivity, constitutional due process concerns, and the nightmare of illiquid asset valuation.
Exactly. And we also connected this urgent local battle to the essential national debate over 4 different federal proposals, showing how Washington is trying to find ways to tax unrealized gains through mark-to-market and excise taxes on loans, bypassing the static net worth problems that California faces.
And we reflected on the long, difficult history of wealth taxes globally, highlighting why models failed across Europe due to complexity, capital flight, and low revenue yields. It really leads to the necessary conclusion that policy design trumps political intention every time.
So what does this all mean for you, the learner? The 2026 Billionaire Tax Act is far more than a simple revenue measure. It's a profound stress test of federalism and economic mobility in the 21st century. California's experience, where an estimated $700 billion to $1 trillion in wealth has already reportedly left the state based on the anticipation of the tax base, a potential 50% reduction in the tax base, proves definitively that policy success depends on technical design as much as progressive intention.
And this raises an important question for you to consider as you process all this information. If state-level attempts risk losing a critical portion of the entrepreneurial and tax base, and if national attempts face enduring constitutional hurdles and are still vulnerable to the sophistication of offshore havens, does the primary, perhaps the only viable path to taxing extreme wealth effectively rely on the international coordination models proposed by Zucman and the G20?
Right. Can any single democratic state truly govern global capital unilaterally, or is the era of tax havens only conquerable through a mandatory global minimum wealth tax enforced by international treaties and cross-border asset registries? It's a fundamental question about power and governance in the 21st century.
Whether the California initiative ultimately becomes a costly cautionary tale that provides valuable lessons, or whether it somehow succeeds against the odds, the outcome will shape the global conversation about the social contract for decades to come. Thank you for joining us for this deep dive.